Welcome back to the Deep Dive. Today, we are tackling one of the oldest and, I think, most destructive debates in personal finance.
Oh, absolutely. The siren song of market timing.
Exactly. Market timing versus that almost monastic discipline of a simple buy-and-hold strategy.
Right. And for decades, the conventional wisdom has been that trying to jump in and out of the market is just, well, it's really difficult. It requires incredible skill.
But what if the data suggests it's more than just difficult? What if the actual structure of the market makes timing, fundamentally impossible?
Statistically ruinous.
And the primary way that otherwise really smart people just destroy their long-term wealth?
That question right there, is it just difficult or is it structurally impossible? That is precisely the mission of this deep dive.
Okay.
We are taking a really forensic look at the arguments against timing, and it's rooted in nearly a century of historical S&P 500 data.
How far back are we going?
We're running from the pre-Depression era, 1928, right up through the end of 2025.
So our goal here isn't to argue philosophy. It's to find the cold, hard statistical proof behind what's famously known as the rule of 10 best days.
That's it. That's the core mission. We want to show that the vast majority of long-term returns, they're not accumulated evenly, day by day.
No slow and steady climb.
Not at all. They are concentrated, and I mean shockingly so, in a vanishingly small number of trading sessions.
And the implication of that is just devastating for anyone trying to be tactical.
It is, because the very act of trying to avoid the downside, which is the whole point of timing,
Right, to protect your capital.
that very act often guarantees you'll miss the necessary upside recovery.
And we have a perfect and very recent case study that illustrates this with just brutal clarity. You're talking about the extreme volatility we saw in 2025.
I am. Specifically, that intense 7-day tariff bear market and the single day that followed it, April 9th.
One day.
One day, April 9, 2025. The S&P 500 generated a historic single-day gain of 9.5%. That one session, triggered by a sudden, completely unpredictable policy reversal, dictated the entire year's performance for millions of investors.
So it's the perfect modern illustration of why being out of the market for just a handful of days
Less than 0.04% of the calendar.
can destroy decades of compounding. We're going to unpack the data that shows this asymmetry isn't an accident. It is, in fact, the fundamental mechanism that drives equity returns.
Exactly. Let's get into it.
Okay, let's unpack this structural flaw first before we even get to the behavioral side. Why is market timing flawed right out of the gate?
Well, our sources suggest it requires investors to abandon what they call the comforting fiction of normal distribution in financial markets.
The bell curve, the one we all learned in school.
The classic symmetrical bell curve, yes. The Gaussian distribution. We're taught to visualize returns using that, but the market clearly operates way outside that framework.
And that bell curve is beautiful in theory, isn't it? It suggests that most days are average and that extreme days, like the S&P surging 4% or 5%, should be.
Statistical unicorns.
Right. Events that are so rare, they might happen once every few centuries.
But the statistical reality of financial markets just completely contradicts this.
And this reality is captured by a term our listeners might not hear every day, excess kurtosis.
Correct. When we look at the historical returns, we see what statisticians call excess kurtosis, or what we can just call fat tails.
Okay, break that down for us. What does kurtosis mean here?
Think of it as a measure of the peakiness of the distribution and, more importantly, the fatness of the data at the extreme ends.
The tails.
The tails.
Yeah.
If the market followed a normal bell curve, the middle would be wide and the tails would be super thin. But in the real world, the central body of returns, those days where the market moves, say, plus or minus 0.5%, is incredibly thin.
Most days are just boring.
Most days are boring, but then you have these enormous unexpected spikes and drops, the fat tails. Extreme outlier events happen with, surprising and often clustered frequency.
So the biggest gains and biggest losses are what really define the market's long-term returns.
Precisely.
Yeah.
The average day is basically meaningless noise.
So the implication is clear.
Mm.
The S&P 500's impressive annualized return, that, roughly 8% we always quote since 1928?
Right.
That's not achieved through some smooth, predictable, steady upward climb. It's not a river flowing to the sea.
It's more like a geyser erupting sporadically. You get these long stretches of flat, often disappointing performance that are punctuated by these violent, explosive upside bursts.
And when you look at the data, the asymmetry is just Staggering.
It is. When analysts surgically remove those outlier events, specifically the top 10 trading sessions of each year, the remaining 96% of trading days don't just achieve a smaller return.
They lose money.
They actively, systematically destroy capital.
That finding alone should make every active trader just stop and rethink their entire strategy. Let's quantify that loss, because the numbers here are really the cornerstone of this whole argument.
They are, and the quantification is stark, built on that nearly century-long data set. A fully invested portfolio from 1928 through late 2025 achieved an impressive annualized return of about 8.0%.
Not bad.
Now, assume an investor was trying to time the market, and in doing so, missed only the top 10 trading sessions of every single year.
Just 10 days a year.
Just 10. That portfolio's annualized return completely inverts. It drops to a startling negative 13.0%.
From plus 8% to minus 13%, that's a 21 percentage point performance swing annually.
It's a 2,100 basis point performance gap. We are talking about a massive chasm, not a small rounding error.
And when you compound that over decades.
As we'll get into later, this is the functional difference between generating significant wealth and having virtually nothing left.
So the analysis reveals that the entire equity risk premium.
The entire thing. That essential excess return you get for holding risky stocks compared to, safe treasury bills.
Right.
It is dependent solely on capturing these outlier events.
Wait, let me just probe that. If the whole premium depends on just those 10 days, what happens to the investor who misses them?
They bore all the market's volatility. They suffered through the crashes, the geopolitical fears, the daily stress.
They took all the risk.
All the risk. But they received a net return that was actually worse than just holding cash or safe short-term bonds. The market effectively charged them the full price of volatility but delivered zero benefit.
Wow. So the reward isn't distributed with the volatility, it's clustered.
Absolutely. And this isn't some modern anomaly. We have historical corroboration from a massive Bank of America study.
How did they find?
They looked at 90 years, from 1930 to 2020. They quantified the ultimate price of timing, missing just the 10 best days per decade.
Per decade, not per year.
Per decade. A tiny fraction of trading days. It reduced cumulative returns from a staggering 17,715%.
That's down to what?
Down to a mere 28%.
28%.
Yeah.
So missing 10 days per decade destroyed 99.8% of the potential wealth.
That's the math. Over 9 decades, almost all the wealth of the U.S. stock market was generated in just a handful of weeks. It is not a slow, steady trickle. It is a violent, unpredictable gush that happens when sentiment is at its absolute worst.
Okay, that statistical loss is bad enough. But here's where it gets, I think, even more complicated for the timer.
It does.
When we move beyond the theoretical gross loss, the reality for a market timer is even worse when we apply real-world friction.
Ah, yes, friction. The silent, often overlooked killer of the tactical trader.
It's not just about picking the right entry and exit day. It's about the mechanics and the costs of just moving money around.
The moment you sell to avoid a perceived downturn, you incur 2 major real-world costs that passively invested money just doesn't face.
Taxes and transaction drag.
Exactly. Let's start with taxes, because this permanently impairs your ability to compound.
Right. Selling to realize a gain, even a small tactical one, crystallizes capital gains.
It does. And if you sell an asset you held for, say, 11 months, you're paying the higher ordinary income tax rate. Short-term capital gains. That could be 35% or even higher.
Whereas the long-term rate is much lower.
Much lower. But the market timer, by definition, is selling quickly to avoid a drop. So they are often selling positions they've held for less than a year.
So if the investor has a 15% gain on a position before they sell it tactically, and they pay 35% tax on that gain.
That 35% tax instantly reduces the capital base available for compounding. That chunk of money is gone forever, paid to the tax man.
It's a permanent hit.
It's a permanent hit. The passive buy and hold investor, assuming they hold for decades, keeps that 15% gain invested in compounding tax deferred. The timer has incurred a financial penalty that the passive investor might not face for 30 years.
And then comes the almost impossible challenge. The re-entry problem.
Precisely. To simply break even with the passive investor, the timer has to make 2 perfect market calls, a successful exit and a successful re-entry.
And that's not all.
No. They also have to earn back enough to overcome that initial tax drag, transaction costs like commissions and bid-ask spreads, and the inflation cost of holding cash.
So the hurdle rate for success, as our sources note, becomes practically insurmountable.
You're not just fighting the market and the statistics, you're fighting human nature and the tax code too.
And this structural reality, it holds up even in the most volatile times in history. Let's talk about the 1930s, the Great Depression, the ultimate crucible for this theory.
It was immense, protracted trauma. The market lost nearly 90% from the 29 peak to the 32 trough. But what's consistently overlooked is that this period of maximum pain was also host to some of the most spectacular, explosive daily rallies in U.S. history.
The biggest down days were clustered right alongside the biggest up days.
They were, because the market was intensely sensitive to regulatory and policy uncertainty.
So when a policy was announced, like a government intervention,
The market didn't take time to digest it.
no.
Consider 1932 to 1933. The market rallied over 50% in 1933 alone. A stunning recovery.
But it didn't happen smoothly.
Not at all. It occurred in violent, short bursts following sudden, unexpected policy shifts, like FDR closing the banks or the U.S. abandoning the gold standard.
And the trauma of the crash paralyzed people. They were waiting for definitive proof that the economy was safe again.
And that waiting was fatal. The investor who sat out, paralyzed by fear, waiting for unemployment to drop, they missed the entire bounce.
And that bounce was critical.
It was. It's what kept the long-term cumulative return above water. That Bank of America data, the 17,000% versus 28%, is largely driven by how punishingly concentrated the recoveries were during the Depression.
Now, critics often argue that pre-World War II data is irrelevant today. They say our modern digital algorithmic market is more efficient, less prone to those swings.
It's a reasonable assumption, but the data suggests the opposite has occurred. The speed and efficiency of modern markets have actually increased the penalty for timing.
The asymmetry is accelerating.
It is. Let's look at the numbers for the modern era, from 2016 through late 2025. Over that recent decade, a fully invested S&P 500 yielded about 14.0% annualized. If you missed just the best 10 days per year,
Same parameter.
the same parameter, that annualized return drops to a massive negative 9.0%.
That's a 2,300 basis point gap. So the cost of being tactical today is actually higher than the nearly century-long average.
Correct. The returns are compressing even further into these brief windows, and the specific examples from the last 2 years really illustrate how devastating this is.
Let's focus on 2023 and 2024.
In 2023, the S&P 500 rose 24%, a stellar year. But if you surgically remove the 10 best trading days, the annual gain drops to only 4%.
Just 4%.
Now look at 2024. The index rose 23%. Without the 10 best days, it also only rose 4%.
So what does this mean for the listener? In both of those phenomenal market years, the real gains, the performance that actually beat inflation and bonds.
We're entirely dependent on approximately 2 weeks of trading.
2 weeks. Roughly 0.04% of the calendar days.
The other 99.96% of the time, the market was just generating inflation-level performance. The alpha, the reason you hold stocks instead of cash, was entirely concentrated in a few highly volatile, unpredictable sessions.
And we have to address the lost decade of 2000 to 2010. Timers always point to that.
Even in flat markets, the rule of 10 best days is paramount. That period produced near zero nominal returns. But those best days were the only thing preventing a negative nominal return. If you missed them, you didn't just tread water.
You actively destroyed capital. You turned stagnation into a capital loss.
Which, coupled with inflation, was a disastrous outcome.
Okay, let's zoom in on 2025. This case study is the centerpiece of the source material because it provides the perfect recent laboratory for the best days thesis.
It's the ultimate example of volatility clustering in a modern setting. Let's look at phase 1, the tariff bear market that ran with frightening speed from April 2nd to April 8th, 2025.
The context was highly geopolitical, and it immediately threatened globalization.
Correct. The U.S. administration announced a sweeping package of new tariffs. The market's reaction was just visceral. Analysts saw it as a harbinger of a global recession.
I remember the media narrative shifting overnight. The administration tried to brand it Liberation Day, but the market's response was clearly Liquidation Day.
The crash details were severe. Over those 7 trading sessions, the S&P 500 was approaching a 20% drawdown. Sentiment was beyond negative. It was apocalyptic.
And this wasn't just fear, right? We had immediate, concrete evidence of the panic in specific sectors.
Absolutely. Airlines and manufacturing stocks were just decimated. A textbook example is Delta Airlines. They were forced to pull their financial guidance during this week.
So this was real corporate evidence that the world was deteriorating.
It was, and it justified the panic for any rational investor. So imagine you're that investor on April 8th. Everything is telling you, sell, protect your capital.
And that's what millions did. Then came phase 2, the pivot, on Wednesday, April 9, 2025.
And the entire rational narrative just broke because of a sudden, unpredictable policy shift.
It was purely external. It wasn't that Delta's guidance improved, it was exogenous.
Exactly. The reversal was sudden and political. A pause or a partial rollback of the tariffs was announced, ironically, via social media. It caught institutional traders completely off guard.
So not a change in fundamentals, just a reduction in perceived political risk.
And the uncertainty just evaporated in a matter of hours.
And the market reaction was historic.
The S&P 500 exploded higher, registering a staggering 9.5% gain in a single session.
Let's just pause on that number. 9.5% in one day.
Our sources confirm this was the third best trading day since 1940. In our modern, hyper-efficient environment, a single policy reversal generated nearly a tenth of the index's value in 8 hours.
But the size of that move suggests it wasn't just passive buyers. What were the market mechanics behind that surge?
It was a massive technical explosion, an everything rally. 98% of S&P 500 stocks advanced, and crucially, the move was amplified by a colossal short squeeze.
So people who successfully timed the downside
suddenly saw their profits vanish and turn into massive losses. They were forced to cover their shorts, meaning they had to buy stock back. At the same time, prices were rising dramatically.
Forced buying meets a vacuum of liquidity.
And the result is prices go vertical. It was a vicious cycle for the bears. The Delta Airlines example is perfect. On April 8th, the stock was in freefall, looked uninvestable.
And 24 hours later,
it soared 23.4% in one day.
So the investor who sold their Delta stock on Tuesday, protecting their loss, only to watch it roar back 23% on Wednesday. I mean, the regret must have been immense.
Their capital was just vaporized relative to the market. Now let's look at the staggering consequence for the total year 2025.
What does this all mean?
For 2025, the full year return was a healthy plus 16%. However, the return excluding the 10 best days, and April 9th dominated that group, was a disastrous negative 12%.
That is a 28 percentage point swing driven entirely by that 1 week. The entire success of the year rested on the choice to be present during 7 days of panic and 1 day of euphoria.
And this is the ultimate psychological hurdle. The timer sold on April 8th, fueled by apocalyptic headlines. They watched the market rip 9.5% higher. Now they're in cash, but they face buying back the same assets 10% higher.
We're waiting for a dip that may never come.
And because of powerful behavioral traps, which we'll get into next, most choose to wait. They lock in a massive opportunity cost, and they're permanently behind the buy and hold investor.
Okay, so we've established that missing the best days is mathematically ruinous. The immediate counter-argument, and the one every timer relies on, is this. If missing the best days is bad, why not just try to miss the worst days?
It's a great question, and it's mathematically true. If you could miss the 10 worst days, you'd get incredible returns.
Okay.
The problem is that it is operationally impossible to miss the worst days without also guaranteeing you miss the best days.
And the reason for that is something called volatility clustering.
Exactly. Volatility clustering means that periods of high stress produce both the largest drops and the largest gains. They are intrinsically linked, like two sides of the same coin.
The huge gains don't happen when everything is calm and orderly.
Never. I like to think of volatility like a hurricane. You get extreme wind and destruction, but the biggest surge of tide often follows the immediate calm after the eye passes over.
And our source material has a crushing statistic on this correlation.
It does. Over a 20-year period, the data shows that 7 of the best 10 days fell within 2 weeks of the 10 worst days.
7 out of 10.
And even more telling, 6 of the 7 best days occurred after the worst days.
That statistic is the fatal flaw of market timing. It means the moment of maximum pain is a prelude to maximum gain.
You cannot separate them. We just saw this in 2025. The April 9th surge, a best day, happened immediately after the crash, which contains several worst days. They're part of the same complex.
Which brings us to the baby with the bathwater problem.
The operational impossibility. To miss the worst day, you have to be out of the market. But because the best days cluster so closely, being out ensures you miss the recovery.
So the passive investor suffers the drop but immediately captures the rally, ending it net positive.
The market timer, however, panics after the drop, sells to protect capital, and is sitting in cash when the rally happens. Their net result is a permanent loss plus costs plus tax drag. They successfully captured the downside, but they fail to capture the upside.
And this is why studies consistently show the average investor significantly underperforms the very indexes they try to invest in. It's not a lack of intelligence, it's a systematic behavioral trap.
It's a behavioral reality first and a statistical reality second. The reason people miss these days is rooted in the architecture of the human brain. We have to talk about prospect theory and loss aversion.
From Kahneman and Tversky, how does loss aversion apply to that April 2025 scenario?
Loss aversion dictates that the pain of a loss is felt roughly twice as intensely as the pleasure of an equivalent gain. When the S&P was drawing down 15% in April, the emotional pain was acute.
And that pain triggers a physiological response.
It does. The amygdala, the brain's fear center, overrides the prefrontal cortex, which handles rational, long-term planning. Hitting the sell button isn't a financial decision, it's a primal survival response to reduce immediate pain.
And selling provides that immediate emotional relief, a false sense of safety.
Yes. But that relief is purchased at the expense of future returns. The investor prioritized emotional comfort today over long-term financial logic.
We also have recency bias driving these poor decisions.
Absolutely. On April 8th, the recent trend was violently down. The timer extrapolated this, assuming April 9th would be the same. They were looking intently in the rearview mirror.
But the market is a forward-looking machine.
It's a discounting mechanism. When the tariff pause hit, the market instantly repriced the future outlook, completely ignoring the painful recent past.
And finally, the behavioral disaster that follows any missed opportunity: regret avoidance.
This is the final nail in the coffin. Once a timer has sold and missed a massive best day, like that 9.5% surge, the idea of buying back in at a price 10% higher means admitting a mistake.
Which is psychologically very difficult.
It's easier to stay in cash and hope for another crash to validate the original sale than to re-enter at a higher price. This fear of regret keeps investors on the sidelines for months, even years, permanently crippling their plan.
So if the data is this definitive and the psychological traps are this well established, we need to analyze the ultimate long-term cost of this behavior.
The crippling of compounding. It's often called the eighth wonder of the world, but it relies entirely on a consistent positive growth rate. When timing flips that rate from a positive 8% to a catastrophic negative 13%, the effect over decades is total financial destruction.
Let's use the $100,000 invested example from the appendix to make the numbers clear.
Okay, you start with $100,000. If you get the fully invested 8% annual return over 30 years, your wealth grows to just over $1 million.
$1,006,265 to be exact. A powerful result.
Now let's apply the annualized return for the investor who missed the best 10 days per year. Negative 13%.
That $100,000 doesn't just stagnate. It evaporates.
It shrinks to a meager $1,500 over those 30 years.
$1,500.
That is not a typo. The initial capital is almost entirely gone. The insight here is crucial. Missing the fat tails results in depression returns, not just average returns. You have fundamentally destroyed the compounding mechanism itself.
And the problem of holding cash has been made so much worse by the return of inflation in the 2020s.
Absolutely. Cash drag is no longer a minor inconvenience. Holding cash is a guaranteed loss of purchasing power.
Let's go back to the 2025 analysis. The buy and hold investor was up 16% nominal.
And assuming, say, 3% inflation, they achieved a significant real return of about 13%. They gained real purchasing power.
But the market timer, who was down 12% nominal.
In real terms, they are down closer to 15% or more. In that single year, the wealth gap between the owner and the timer widened by nearly 30 percentage points.
So given all this evidence, the strategic mandate for any investor must be unwavering.
The primary actionable mandate is clear and explicit. You need to own stocks and commit to unwavering participation. Continuous exposure is the only way to guarantee capturing the next April 9th surge.
So volatility is not the market's failure. It's the price of admission.
Volatility is not a bug. It is the fee you pay for equity outperformance. Trying to avoid the fee by liquidating during stress means you lose the product. Enduring the worst days is what structurally earns you the right to profit from the best days.
But I need to challenge this. If the crash of April 2025 caused an investor to panic and sell everything, doesn't that prove their strategy was wrong to begin with?
It proves their asset allocation was wrong, not their trading ability. Panic is a sign that the investor's equity allocation was too high for their actual emotional risk tolerance.
So the solution isn't tactical selling.
No, that's timing, and it's doomed. The solution is structural risk management through a system, not prediction.
And how does diversification serve as the ultimate anti-timing mechanism?
A stable 60-40 portfolio, for example, dampens the emotional urge to capitulate. When the market drops 15%, your portfolio might only drop 8% or 9%. That reduced pain helps prevent the amygdala from hijacking your decisions.
You're managing the risk by setting a boundary before the volatility hits.
Exactly. And the second benefit is the disciplined alternative to timing. Systematic rebalancing.
Right. This forces the investor to do the opposite of what their emotions tell them.
It's the disciplined cousin of market timing.
Yeah.
It removes emotion. On April 8, 2025, when the S&P 500 had crashed, a rebalancing algorithm would have seen that your stocks were underweight.
And would force you to sell what worked bonds to buy what didn't stocks.
It forces you to increase exposure right before the April 9th pop. It achieves buying low without requiring clairvoyance. It transforms the panic response into a profitable mechanical action.
This has been a powerful deep dive into the structural reality of equity returns. To recap the main thesis, the equity market is fundamentally asymmetric.
It's characterized by those dangerous fat tails. It delivers the vast majority of its gains in brief, violent, unpredictable bursts that emerge from periods of maximum despair.
Just like the 2025 tariff bear market.
The data is definitive, and it demands humility. Since 1928, an investor's entire financial success hinges on their presence in the market during roughly 0.04% of trading days.
To miss those crucial 10 days per year is to negate the entire benefit of equity ownership.
The enormous swing we saw in 2025, 16% up for the steadfast, 12% down for the absent, proves this rule is a living, dangerous dynamic.
Therefore, the prudent strategy demands humility, discipline, and participation.
It demands an acknowledgement that predicting the next April 9th is impossible. The investor must commit to unwavering participation. By enduring the stress of the worst days, you earn the absolute mathematical right to profit from the necessary and often instantaneous best days.
Time in the market is not just a slogan.
It is the mathematical prerequisite for long-term wealth creation.
Since the source material confirmed that the market relentlessly rewards patience, we leave you with this final provocative thought. If the statistics prove we can't be smarter than the market by predicting the next crash, what would a real working systematic strategy actually look like?
Could an algorithm exist that filters out the entire downside of a crash without falling prey to volatility clustering and missing the bounce?
Or is the ghost of the perfect trade the one illusion that will forever separate the wealthy from the perpetually tactical? We'll leave that question hanging for you to mull over. We'll see you next time on The Deep Dive.